Welcome back to another YouTube video. Today we're going over Bbby stock. Make sure to subscribe and leave a like to reach as many people as possible. Now, thank you guys all so much for the support. My other video got 1,000 views. We definitely reached a lot of people. It's my third time recording this video, so please leave a like. So today we're going over how I think the squeeze is going to happen, and controversy, and the daily action for like the next few trading days. Kind of like a micro and macro scale look. So I've been getting a lot of complaints about the titles I've been making. And the average watch time for my videos are 3 minutes. Now, don't get me wrong, I'm very grateful, but the people complaining definitely did not watch the video all the way through. I'm not throwing shots at them either. I'm just going to explain what I mean. So I made video like, I don't know, short squeeze tomorrow. That was true. And I went over the scenarios of what could happen. So over here, we had this ascending triangle. And on this candle right here, I said short squeeze tomorrow. That was the title. However, later on in the video, I went over the 3 scenarios. 1, this was the day of financial news. The financial news was good. We break out of this triangle with volume. As you can see, the volume was high as well. We fill this gap at 16. There's not much stopping it from going all the way to 2250. This could be the momentum we need and the volume we need to start seeing some shorts cover. They've been on a lot of stress lately. The cost to borrow, the days on loan, a lot of stress for them to cover with that type of momentum. 2, the news wasn't good, wasn't bad. We just follow up this line and just play this like a normal technical pattern, break out with volume. Maybe we see a squeeze, maybe we don't, but we will fill the gap at 16, definitely. And 3, the news is horrible. We break down off both of these resistance levels. I'm in support. I always get them mixed up, but I know what they are. I'm sorry, I'm just not thinking. And we come back down and we fill this gap at $8.10 or $8.16. Now, I'm actually so glad that we filled this gap. If you've been watching this channel for a while, you know that I love and hate gap fills. Look at the probability of a gap fill. 92.2% of the time, gap fills fill. And I was saying over here, this trading range. Sorry, my brain's not working that well. I just woke up. Over here, I was saying, look, I don't know if it's worth trying to get in a few bucks cheaper, around 8.20, right? Just because this gap could fill first. It was all about predicting what gap was going to fill first. Was it this one or this one? And now, why would this gap fill? Take ATA, take AMC. Look at the chart patterns. Every time before they ran up, they gapped up. They gapped up, and then inevitably, they came back down. Up hundreds, up thousands of percent. They came back down and filled the gap at the very start. But now, what do we have? We have a filled gap, a solid foundation, if you will. Something that we need to be proud of and happy of and not scared of, because now we can really run sustainably. We also have this gap ramp. What's a gap ramp? Right here, we've got a gap all the way up here. Now, this is the whole idea of a gap ramp. As we bounce off support, which is at the bottom of this gap, and we come and we fill the gap at about 1150. That brings the momentum and the volume we need to come back in this pattern, maybe trade in this range, and then boom, we break, fill the gap here, and then boom, fill the gap here, because the momentum and the volume brings into the stock from filling these gaps. It's a 50% move, 50% move, 50% move, brings eyes onto the stock, and then we can try test this all-time high, and maybe squeeze, maybe don't. Now, I'm going over something very important that I haven't really seen mentioned, and this is my own opinion, but I do believe it's true. I don't think you're going to see a short squeeze without a gamma ramp. I think a short squeeze, maybe not by definition, but is always a mix of a gamma ramp, FOMO, and short squeeze. I'm going to explain why option chain is more important than the shorts. Let's take the option chain. I'm just going to be using this as an example, right? So if you guys don't know how kind of like hedging works, you have one contract. Let's say you brought one contract at $1. This means if the strike price is $1, you brought one contract at $1. If the price ends above $1, you have the right to exercise your options if they're calls. Now, what does exercising them mean? Exercising means like converting them into 100 shares at the strike price. So like if your strike price is $1, you have the right to buy 100 shares per contract at $1. Now, there's a thing called hedging. Hedging is when the market makers have to make sure they have the shares available just in case they exercise. Because if the shares aren't available to be exercised, they get in a lot of trouble. They get in a lot of trouble. It raises a lot of questions. It's just a big no. It's something that they can't do. It's not even like fail to deliver. It's when you get margin called, you don't pay off, cover your shares in time, don't get in too much trouble. No, they'll get in serious trouble if the shares aren't there. Right? Because they're just, you can't do that. You can't do that. If the shares aren't there, it just ruins the whole option chain market and everything. So, A gamma ramp is when you have a consistent amount of contracts that are just coming in the money. And this is how it works, right? Let's take $9. If we, this is perfect example. Right here, 31,000, they would have to hedge 3 million shares. So they would have to buy 3 million shares just in case they exercise. They have to be brought by the end of the trading day of the week. So they'll buy 3.1 million shares here. And the whole idea is this: when they buy these shares, it pushes the price up to the next strike price, $9. And then they have to buy the shares here, and it pushes the price, and it just keeps going and keeps ramping up the price. Sometimes market makers are smart in the way they do it. They already buy shares previously, like it could be weeks, could be days before anything could even be in the money. So they do it over a period of time. So they already have the shares available to exercise if they need. Sometimes they don't do it smart, and that usually happens when there's a huge gamma ramp. Take January 20th, for example. This gamma ramp is crazy. If you want to see this stock be the biggest short squeeze stock of all time, we need this gamma ramp on our side. There's like 400,000 contracts here, and they're still like 5 months away. There's so much more time for more contracts to be brought. What does this mean? This means like 40 million shares have to be brought. That's half the free float. That's more than the shorts that we have according to Ortex. And the only thing that I like about this more is because that's half the free float that they have to buy by the end of the week of January 20th. They have to buy by January 20th. They have to buy 40 million shares by January 20th. With short squeeze, what do you have? Well, you've got margin calls, which are actually way harder to get than people realize. You can add more money to your account not to get margin called. When the price is all the way up here, you got to think like a short, right? If you're a short and you short at $4, the stock goes up to 30, you're not going to cover. And that's exactly what happened. If you check the Ortex data, short interest was at an all-time high here, and then it was down about 20% here. This is because if you're a short, you don't want to cover at 30, you want to cover at the lowest price possible. So they started covering down here because they saw this as a good opportunity to get out. Probably explains a little bit of the volume, a little bit of the price action. Now, if we take two together, that's 50% of the free float that has to be brought in a week. Or like, unless they have the shares available before. But anyway, half's the free float, and it's all buying pressure. 50% of the free float's buying pressure. Then you can definitely see a short squeeze. Because if you want to see a margin call, it has to typically be higher than this. Like, sure, a couple shorts might be margin called at $30, 25. But if you want to see the big boys, the big hedge funds get margin called, you got to see something higher than this. You got to see something more risky than this on their side. That gamma ramp, or any other gamma ramp, right? If you combine the two, we start ramping up the gaps, gap up, gap up, gap up. Gamma ramp, right? We're at 22.50. They have to, all of a sudden they have to buy 20 million shares. Boom, we're at all-time highs. And then at $30, they have to buy another 20 million shares. Boom, we're at $40. Then shorts start to cover. Boom, you've got your short squeeze. You've got your moon. You've got your MOAS. This definitely has the potential to be the MOAS. This setup is insane for January 20th, right? It's just all about getting it right. Getting it right. Now, if you want to see a short squeeze, I think that you need to have a gamma ramp with it. And this can come at the same time as momentum. If momentum is building up in a stock, I don't know, this is at like $8, then it goes to 15, right? There's going to be a lot of momentum, a lot of volume, a lot of attention on the stock. Then people will start buying calls because it's parallel. The stock price is going up volatilely. Calls will be going up volatilely as well. They're parallel to each other. So with this gap ramp, right, we start gapping up. 22.50. Everyone's freaking out about the stock. All of a sudden, we've got a gamma ramp for next week. The gamma ramp finishes in the money. Gamma ramp's all the way at $40. We're at $40. Then shorts start to cover. We've got like 50% short interest. And then we've got the gamma ramp for next week and next week and next week and next week. And there's just a continuous amount of gamma ramps. Or like we're in January 20th. The gamma ramp's all the way at $80. There's 10 million shares they have to buy at $80. That's literally a short squeeze. The gamma ramp is literally a short squeeze. You get to $80, right? They have to buy half the free float. I don't know. It goes to $100. Then short start to cover. Boom. That's got your MOAS. That's how the squeeze could happen, right? And it all comes down. All starts with this gapping up here, building momentum, building momentum, building momentum, in both the option chain and the stock price. That's it for this video. Hope you guys understand. That was really bad at explaining. Thank you guys for watching.